What's up, it's Ron. Today we're diving into one of the most powerful tools in the trading game, Fibonacci Retracement. Whether you're day trading, swing trading, going long, shorting the market, this tool seriously will level up your entries and your exits. Quick disclaimer, nothing is financial advice. Always do your own research. And hey, if you appreciate insights like this, hit the like button. It really helps put this video in front of other beginners trying to learn how to trade crypto, and it'll help your boy out, so it's super appreciated. Stick around until the end because once we cover the basics, so you really understand what you're looking at, we'll jump straight into charts and break down how to actually use Fibonacci in real trades. Basically, the idea is this. Markets don't move in straight lines. When crypto goes up or down, it usually will pull back a bit before continuing. Fibonacci retracements help us predict where that pullback might stop. It shows us key zones where price might bounce, giving you clean opportunities to enter, exit, and protect your position. Now, it's based on something called the Fibonacci sequence. We're not gonna nerd out here, don't worry, but what matters are the main levels: 0.236, 0.382, 0.5, 0.618, 0.786. These just represent how much the previous move has retraced. In other words, how much of the move price is giving back before it potentially continues. And this is what we will go over today and apply it to trading. It can help us figure out where to buy the dip, where to set our stop losses, where to take profit, and just like the moving averages, which we broke down in the last video, Fibonacci levels often become self-fulfilling zones. Why? Well, because so many other traders use them. The market tends to react around these areas, and that's why it works. All right, so first things first, I always start by identifying the trend. This is super important. I ask myself, are we in an uptrend or a downtrend? If the market is making higher highs and higher lows, I know that I'm in an uptrend. Now, if the market is making lower highs and lower lows, then this tells me that we're in a downtrend. Okay, so then why does this matter? Because trading with the trend gives me a much better chance of success. Trying to trade against the trend is like swimming upstream. It's possible, but way harder and riskier. Once I've figured out the trend, that's when I bring in the Fibonacci retracement tool. I use it to find clean entry points that line up with the overall direction of the market. In an uptrend, I look for the price to pull back to the key fib levels, 0.5 or 0.618, the golden zone, and then bounce. That's usually a good spot to get in and ride the next wave up. And in a downtrend, I do the same thing, but in reverse. I wait for the price to pull back and then continue dropping. This process keeps me patient and disciplined instead of just chasing the price or making random trades. I wait for a high probability setups that make sense. It's all about working with the market and not against it. Now, we want to look at the levels that actually matter. When you draw your fib retracement tool from the swing low to the high in an uptrend, or the high to the low in a downtrend, you see levels like this: 0, 0.236, 0.382, 0.5, 0.618, 0.786, and 1. Between 0.5 and 0.618 is what we call the golden zone. It is very well respected, and it's something that you really want to pay attention to. Pretty much your whole reason for using the Fibonacci tool in general. So out of all of them, the 0.618, the golden ratio, is crazy powerful. That's the level that I pay the most attention to. These Fibonacci levels can seem confusing, but they're just percentages. For example, 0.5 is 50%. 0.618 is 61.8%. Set 0.786 is 78.6%. 1 is 100%. These are all percentages. It's where the market often pulls back before resuming the trend. A lot of big players react to this zone. So when price hits it, I'm watching closely for my entries. And just like we talked about with moving averages, the higher the time frame, the more weight that these levels carry. So a fib retracement on a 4-hour or a daily chart is going to be way more reliable than the one on a minute chart where the price is bouncing around like crazy. Here's how I use it. Short time frames like 15-minute or 1 hour for scalps and quick plays. Higher time frames, 4-hour or the daily, can be for stronger support, resistance, and swing setups. Same rules apply as before. Lower time frames, speed and noise. Higher time frames, clarity, and confirmation. Now let's look at Sol USD on the daily chart. At the top, we can change our time frame to fit our trading style, whether you're scalping, day trading, or swing trading. We will use the daily chart to illustrate how we're going to use the fib retracement, and we'll go back to look at past examples in this chart and draw out our fib lines so that we can see how the chart reacted. Now there's a lot of time frames to choose from. Remember, I said for me personally, I use the 1 day, the 4 hour, the 1 hour, and the 15 minute. But for this example, we're gonna use the 1 day. First, I'll go ahead and reset my chart view, remove my drawings, and I'm using TradingView, and it's absolutely free, so you can check them out. And that's what I'm using to make this example. So let's go ahead and look for somewhere in time where there's a general uptrend, and we'll go ahead and try to identify a pullback and see how the Fib retracement tool helped us in that way. So let's look for a shift in trend. All right, so right here we see that there is clear downtrend. Right here is the accumulation and then uptrend. So maybe we check here. So I'm gonna go ahead and delete the drawings. All right, now we're looking at this section. We know it's in an uptrend because you'll see higher lows and higher highs. And if you kind of look at this, I'll draw that out for you as well. You'll see higher lows, you'll see higher highs. All right, so I'll remove drawing. That's how I was able to identify uptrend or downtrend. Now I'm gonna draw the Fib retracement lines. In TradingView, you just go right here, click on that, select Fib retracement, and now you're ready to draw. Let's just draw from this down wick to this up wick. Zoom in a little bit here. And what I want to do for you as well is I want to draw the golden pocket, or that golden zone, which is between the 50% and the 0.618 or 61.8%. This is known as the golden zone. All right, so what do we notice here? We notice that the price action, once it goes up and we're looking for an entry for our pullback so that we can enter a long, we'll see that it comes into this golden zone and then it moves back up. That's a short trade right there, but it did go in the right direction, went back uptrend. Now it kind of comes down here and hopefully we took some profit. But as you can see, when it got into this golden pocket, it did a reversal. That's typically why people use Fib retracements as point of entry so that you can enter on these dips, whether you're shorting or you're going long. This is why the tool is used. Now we can go ahead and try it again. Let me go ahead and delete these drawings. And so now we see a pullback and we see this move right here. So say we're trading this move, we would have drew our lines from that bottom wick to this top wick right there. I'm just moving it across so that we can see everything closely. Let me zoom in. Let's draw our golden zone right there. And so what do we notice here? We notice that when it makes this move, it comes back. It taps this golden zone and it does this very parabolic move. That would have been a great entry. That is a huge move. That is incredible. The reason I drew it here is because it made this move. It started pulling back. So I looked for a low point. Now let's say we drew it right there. Let's say we caught it on this move right here. So then all we would do is draw it from this candle to this candle, and let's see if it worked. There it goes. It tapped our golden zone and it made this parabolic move. Let's say you just caught it right here on this pullback and it started coming down like this, but you don't know where to enter. You go ahead and draw it right there. Here's the top wick, here's the bottom wick. Let's zoom in. Look at that. Perfect entry. Comes into this golden zone and makes this reversal that is absolutely beautiful. This will make for better setups, cleaner entries, tighter stop losses. It's an overall top 5 tools I think you should utilize when you are trading. It's absolutely essential. And then what we can do is let's go ahead and look at some short positions. Now, currently right now in the market, it's seeming a bit bullish, so I really don't know if this is going to continue to dip more, but for the sake of this example, let's go ahead and see where we think it's going to go. Now I'm drawing from the top wick now to the bottom wick because we're in a downtrend. Now, if I think we're going to continue to go down, this is what I would do. Comes here, rebounds, enters our golden pocket, kind of steps out of it, and now it's retracing. If you did enter somewhere around here, you may have gotten stopped out right here if you had a really tight stop loss. But say your stop loss was right here or even a little bit higher, you wouldn't have been stopped out. You would still be in the trade. Now, today is a very bullish day, so this could be a sign of a reversal happening. We don't really know yet. That's why when you trade, you have to use multiple Confluence, or you have to have Confluence and have multiple indicators that are signaling the same thing. Fibonacci is just one of them. All right, so now let's take a minute to talk about Confluence. I never use Fib retracement in isolation. When price pulls back to that golden zone or 0.618 and it lines up with, say, the 200 EMA, for example, or strong support level, that's what I pay attention to. And that's where my sniper entries come from. The more confirmation information I have, the more confidence I have in my trade. So you want to make sure to practice this first. If you're new, open TradingView. It's absolutely free, and practice drawing those fib retracements that we just showed you and identifying the lows and the highs in the trend that you're in. And just observe how price has reacted around those fib levels. You'll start to see patterns, and once you do, it'll click. Fibonacci retracements is one of the cleanest ways to find pullback entries into a trending market, whether it's up or down. And it helps me avoid chasing pumps and instead buying the dips with confidence. And when you combine this with other confirmations, Confluence, that's when your setups go from random to high probability. This is just indicator number 2 in this series. Next up, I'm breaking down one of the most slept on indicators, and you do not want to miss it. So if you're serious about leveling up your trading in crypto, make sure you subscribe, turn on those noties, and I'll catch you in the next one.